Hi, everyone, and welcome to the Social Security Planning Strategies for Women. I'm Larry Heller, and also Belinda Tsui is with me today. She's going to be presenting. So before we get into the presentation, just a little bit about Hello Wealth Management. We are an independent, fee-only fiduciary financial planning and investment advisory firm. We help our clients live out their lives their way. Our wholly objective and uncommonly collaborative approach allows us to custom tailor individual financial plans to fulfill each of our clients' unique ambitions and aspirations. And one of the things that we do is Social Security planning and analysis. So myself and Belinda, which I just introduced you, is going to present on the topic today, and that's a Social Security for women. So Belinda, thank you for joining us, and I'll hand it over to you. One thing before I hand it over to you, Belinda, if anyone has any questions, please feel free to use the chat button on your screen, and either I'll answer them or we will throw them out for Belinda.
All right, thank you, Larry. So let's start off with why did we focus on women for today's webinar? Social Security is very important to women. Women represent 56% of all Social Security beneficiaries age 62 and older, and about 66% of all beneficiaries age 85 and older. There are studies that indicate that women are less secure about their retirement versus their counterpart. We want to help women put in place strategies and make use of available resources to increase their confidence about retirement. In one of the surveys that asked about how confident are you in your ability to retire comfortably, the question was asked to 5,900 men and women who are still working. Not surprisingly, women are less confident in their ability to retire comfortably. 36% said they were either not too confident or not at all confident, compared to 28% of men. And then there was another survey asked about some of the financial aspects of retirement. Will you have enough money to live comfortably throughout your retirement years? Only 11% of unmarried women said yes. Okay, forget about living comfortably. Let's lower the standard. Let's talk about having enough money to meet basic expenses during retirement. Just 23% of unmarried women said yes. Are you doing a good job of preparing financially for retirement? Only 15% of unmarried women said yes. By the way, many of these unmarried women were once married. Whether through divorce or widowhood, many married women wind up single at the end of their life. Women in general have greater concerns about their retirement security, yet do less than needed to plan for adequately addressing those concerns. This quote came from a study by MetLife on women, retirement, and the extra long life. Unfortunately, it's true in too many cases, but at least you're here. Whether this is a first step for you or you're one of the savvy ones who have been planning for retirement all along, gathering information about Social Security and other sources of income in retirement is what you need to do to take care of yourself financially. Ladies, here are our realities. Women made a lot of strides in the work world, but there's still a pay gap. On average, women earn 82 cents for every dollar earned by men. This translates to lower retirement savings, lower pensions, and lower Social Security benefits. Yet, women tend to live longer than men, so you need these resources even more. The gender gap means that a full-time working woman will earn $406,000 less than her male counterpart over 40 years, according to a recent study by the National Women's Law Center. Translated another way, a woman needs to work 50 years compared to a man's 40 years just to break even with him. We need to do a lot to make up that gap. Everyone's situation is different, of course, but I just want to mention the value of working a few more years. By not being in such a rush to retire, you may be able to pay down debt, add to your retirement savings, reduce the number of years that you have to draw from assets in retirement, and raise your Social Security benefit. It's just a thought if that option is still available to you. Let's start with the basics and understand the value of Social Security and how you may be able to increase your lifetime benefits. This is an illustration of how meaningful Social Security benefits are. First, Social Security is one of the few sources of income you can't outlive. Social Security will continue to pay until you die. And of course, the longer you live, the more you will extract from the system. If you retire today and start collecting benefits at $2,000 per month, and you live 10 more years, you will receive nearly $300,000 in lifetime benefits. And if you live 30 more years, you'll receive over $1 million over your lifetime. This assumption also factors in an annual cost of living adjustment, or COLA, of 2%. Let's take a look at COLA's impact on your monthly benefit. Social Security offers an annual inflation adjustment to keep up with the cost of rising expenses. So if your benefit starts out at $2,000 per month, and if annual COLAs are 2%, in 10 years, you'll be receiving $2,438 per month. In 30 years, your check will be $3,623. This is what we call the power of compounding growth. There is no way to exactly know what future COLAs will be, but 2% seems to be a reasonable estimate. In 2021, COLA was 1.3%. Speaking of which, many are estimating that we will have the biggest bump in Social Security benefits in 22 years, with predictions recently as high as 6+% for next year in 2022. Social Security typically announces annual adjustments in October. We'll see what happens. Now for the main focus, Social Security rules and strategies. These can be somewhat complex depending on your marital status, but it's definitely worth understanding the different rules and strategies because it's what can help you get more out of the system. Let's start with a series of questions. The first question is, do you qualify for Social Security benefits on your own record? You do if you paid into Social Security for at least 10 years sometimes during your lifetime. It doesn't matter if those 10 years occurred in all one stretch, early in your life or later in your life, or if they are broken up. You just need 10 years of fairly minimal earnings. Regardless of whether or not you are currently married, have you been married before? Is there a former husband, or are there former husbands, dead or alive, lurking out there? Believe it or not, you may be able to receive Social Security benefits based on a former husband's work record. Oops, sorry. If your previous marriage ended in a divorce, if it lasted over 10 years, and if you're currently unmarried, you may qualify for divorced spouse benefits. If your divorced spouse and your ex-husband is deceased, you may qualify for divorced spouse survivor benefits. Death do us part, no kidding. We'll talk more about this later. Even if you're currently married, you can receive survivor benefits based on a former husband's work record as long as your current marriage took place after age 60. Don't try to memorize all these rules right now. We'll explain them more in detail during the presentation. Depending on your answers to the previous questions, you could be entitled to one or more of the following: retirement benefits, spousal benefits, divorced spouse benefits, or survivor benefits. How you coordinate all these benefits is crucial in determining your overall Social Security income. Let's pause for just a moment to define some Social Security terms. The first concept is to understand full retirement age. This is the age at which you may claim full unreduced Social Security benefits. A lot of people think of age 62 when they think of Social Security. That is the earliest age you can claim Social Security benefit. If you claim at 62, your benefit will be permanently reduced by 25% or more. To get your full benefit, you must wait until full retirement age to claim it. The chart shows your Social Security full retirement age based on your year of birth. Basically, from the time you graduate from college, say at 21 or 22, and assume you retire at 67, there's a 45-year spread to claim your Social Security benefit. The next important concept to understand is your primary insurance amount. We won't go into the benefit formula today, but basically your benefit is based on your work history. The system uses your highest 35 years of earnings to calculate your benefit. The higher those earnings are, up to the annual Social Security taxable maximum, that will be $142,800 for year 2021, the higher your benefit will be. This is one reason we encourage women to work a little longer. If you've taken time out of the workforce to raise children or go back to school, there may be some zeros on your earnings record. If you keep working, you may be able to replace some of those zeros with higher earnings and raise your benefits. To find your primary insurance amount, just look at your Social Security statement. It's your benefit amount at your full retirement age. In this example, the benefit amount at full retirement age is $2,029. This is primary insurance amount, or PIA. Now let's talk about retirement benefits. If you worked for at least 10 years in a job and paid into Social Security, you will be entitled to a retirement benefit. If you are over age 60, the Social Security Administration sends you an annual statement 3 months before your birthday showing the amount of benefits you may be entitled to when you retire. If you're age 60, if you're under 60 or any other reason you want to access your statement online, you can go to socialsecurity.gov/mystatement. More importantly, if you haven't done so, register your Social Security account and claim it so that identity thieves do not. You will need to answer a series of questions relating to your credit history. These are for security reasons. Once you answer these questions and set up an account, you'll be able to access your statement at any time in the future. By the way, if you are already receiving Social Security, there is no statement for you. The Social Security Administration stops generating statements for people who are already receiving some form of Social Security benefits. Other ways to estimate your Social Security benefits are to go to their website and click on Estimate Your Retirement Benefits. This method allows you to tap into your work history and gives you an estimate similar to what you would see on your statement. Another way is to use one of the calculators on the Social Security website, and the link is provided for your use. Now, remember that I said that your primary insurance amount, or PIA, is the benefit you will receive at full retirement age. So what happens if you apply for Social Security before full retirement age? As mentioned before, your benefit will be reduced. I cannot emphasize this enough. You can apply for Social Security as early as 62. If you apply for Social Security benefits before full retirement age, you will receive a percentage of your PIA. If your full retirement age is 67 and you claim at 62, you'll receive 70% of your PIA, or a 30% reduction. So if your PIA is $2,000, your permanent benefit will be $1,400. The difference between $1,400 and $2,000 may not seem like very much, but over time, claiming early can make a huge difference in the amount of total benefits you receive, as well as the amount of income you receive each month. These amounts are actually prorated monthly, so you can apply anytime after age 62, and your benefit will be reduced by the appropriate amount until you reach age 67. Conversely, if you apply for Social Security after full retirement age, your benefit will go up by 8% for each year you delay. So if your full retirement age is 67 and you apply at 68, your benefit will be 108% of your PIA. So if you wait until age 70 to apply, your permanent benefit will be $2,480. you can look at it as an 8% raise each year until age 70. After age 70, you can't earn any more delayed credits, so it doesn't pay to wait until after age 70 to apply for Social Security. Let's take a look at the dollar difference in claiming option. Let's say you turn 62 and your PIA is 2,000, and you apply at 62, your permanent benefit will be 1,400. By age 70, with annual cost of living, your monthly income will go up to about 1,640. Or you could delay applying until age 70. With the 8% annual delay credits, your PIA will grow to $2,906 per month. That's a significant difference in why you may want to apply at 70 versus 62. As time passes, the disparity grows wider. When you're 85, your monthly income will be $2,208 if you apply at 62, or $3,911 if you apply at 70. This can make a huge difference in your standard of living. These amounts in the third column may seem high to you now, but they won't seem high when a loaf of bread costs $15. Keep in mind that these numbers are based on an annual inflation of 2%. The actual inflation adjustment could turn out to be different. The when to apply question is very complex and really requires a customized analysis. But here are a few points to remember. If you apply early, your benefit starts out at some fraction of your PIA and remains at that percentage for the rest of your life. Your benefit amount is locked in at the time you apply and only goes up with annual COLA. COLA magnifies the impact of early or delayed retirement because the annual cost of living adjustment is applied to either the lower or higher amount. This causes the disparity to increase with each passing year. The when to apply question impacts survivor benefits as well. In fact, if your husband earned more than you did so that his PIA is higher than yours, it is even more important for him to delay filing. This will increase your survivor benefit. If he dies first, the higher benefit will transfer over to you. So you want to do whatever it takes to maximize that survivor benefit. This way to do that is to have him apply for his benefit at age 70. We'll go into more details about this in a few minutes. Getting stuck with a reduced benefit is not the only reason not to file for Social Security before full retirement age. Another reason is that if you are still working, some or all of your benefit may be withheld due to the earnings test. $1 in benefits will be withheld for every $2 you earned over $18,960 in 2021. Now, this is not a reason not to keep working. You're going to need those extra earnings for both now and in retirement. And if you're managing to save some of your income, but it's a reason not to apply for Social Security before your full retirement age if you don't need the money. For clarifications, the benefits are not taken away in the earnings test, just withheld and credited back to you in the future. After you turn full retirement age, there is no earnings test, so you can receive your full Social Security benefit and earn as much as you want from working without any benefits being withheld. Another reason not to file for Social Security before full retirement age is that you might not be able to take advantage of some of the spousal strategies, which we're going to talk about next.
There is a question here. Someone wants to know, what about the year that you turn full retirement age? How much do you still have to give back some of that money?
Actually, it is prorated. So in the year that you reach full retirement age, the benefits are reduced. Actually, it's a different formula. It's $1 for every $3 above the limit, that the $18,960 that we mentioned before. So the limit on your earnings for the months before full retirement is $50,520. So it's prorated to the month of your birth, before your actual full retirement age. And then once you turn full retirement age, there will be no income limit, earned income limit, correction. on you receiving, on how much you earn, and they won't be reducing your Social Security benefits anymore. Okay, on to spousal benefits. When Social Security was first instituted in 1935, most women didn't work. So the system allowed for spousal benefits to be paid where a woman can draw Social Security benefit off her husband's work record. Fast forward to modern era, most women qualify for retirement benefit on their own record, but you may still be able to take advantage of spousal benefits. And because Social Security is gender neutral, your husband may be able to take advantage of spousal benefits as well. Let's start with a simple example. Jack and Jill are married. Jack's PIA is $2,400. Jill never worked, so she doesn't qualify for Social Security on her own record. After Jack files for his benefit, Jill can file for her spousal benefit. The amount will be 50% of his PIA if she files at her full retirement age. That's $1,200. Or if she files early at 62, it will be 35% of his PIA, which is a 30% reduction. Remember, marriage is a partnership where you and your spouse work together to attain your personal goals. Now we'll focus on how to coordinate your own retirement benefit and your spousal benefit. There are some rules you have to follow here. By knowing these rules, you can make them work to your advantage. First, if you file for Social Security before retirement age, you will receive your own reduced benefits first. If your PIA is less than 50% of your husband's PIA, you may also receive a spousal benefit, provided that your husband has filed for his benefit. If your PIA is more than 50% of your husband's PIA, you will not receive a spousal benefit. Let's put that in an example. Back to Jack's PIA at $2,400 and Jill's PIA is $800. Jill filed for Social Security at 62. Before looking at any spousal benefits, she will be paid her own benefit first. It will be 70% of $800 or $560. Let's say Jack is 4 years older and has already filed for his benefit. This makes Jill eligible for a spousal benefit. Let's see how much it will be. To calculate the spousal add-on, they will subtract her PIA from 1/2 of his PIA. That's $1,200 less $800, which gives us $400. Then the amount will be reduced for early claiming. The $400 multiplied by 0.65 to get $260. Adding together $560 of her reduced retirement benefit and $260 of reduced spousal add-on, Jill will wind up with total benefit of $820. If you feel that Jill should be jumping in joy because $820 is more than her PIA at full retirement, note that this is less than 50% of Jack's PIA or $1,200, which is what Jill could receive if Jill filed at full retirement age. And by the way, if Jack has not filed, just to be clear, she would not be getting the extra $260 until Jack files. If you file at full retirement age and you qualify for a spousal benefit, you may receive the maximum spousal benefit, which is 50% of your spouse's PIA, or if your own benefit is higher, you'll receive that amount. There is a special option for those born before January 2nd, 1954. You can restrict your application to your spousal benefit and receive that benefit for 4 years while your own benefit builds 8% annual delay credits. This is a loophole that is being phased out, but it's still available to a few people. In case you hear about someone who uses a strategy, or for those of you who are 67 years old now, we'll spend a minute on this for you to better understand how the strategy works. Remember, this is only available if the spouse filing the restricted application was born before January 2nd, 1954. In our example, Jack's PIA is $2,000 and Jill is $2,400. Jill turns 66, she files a restricted application for her spousal benefit and receives $1,200 from age 66 to 70. When she turns 70, she switches to her high retirement benefit of $3,168, which has increased 8% per year while she was receiving spousal benefit. Please note the following. Jill cannot file restricted application for spousal benefit before full retirement age for spousal benefit. As I mentioned earlier, if she files for Social Security before full retirement age, she'll be paid her own benefit first and it will be reduced. The whole idea here is to delay her own benefit so it will earn those 8% annual delayed credits. Jack must have filed for his benefit. This is a requirement for spousal benefits. As you can imagine, this was a great loophole and that's why Congress put a stop to it. But if you're grandfathered, you still can do it. If you think you might qualify for this strategy, be sure to come and talk to us at Heller. Now we come to divorce spouse benefits. If you were married for 10 years to the same husband or spouse and are currently unmarried, pay attention. Here are the rules. If your marriage lasted at least 10 years, if you're currently unmarried, and if your ex-husband is at least 62, you may be entitled to a divorce spouse benefit. If the divorce occurred for more than 2 years, he does not need to have filed for his own benefit. He only needs to be 62. Here's an example. Dick and Dora divorced. They're married for more than 10 years. Dora is 62 and currently unmarried. Dick's PIA is $2,400. He is over 62. Dora filed for a divorce spouse benefit at her full retirement age and starts receiving 50% of Dick's PIA, or $1,200. Hard to believe, isn't it? But it's true. And Dick will not be notified that Dora has filed for benefit on his record. Dick's own benefit will not be affected. His current spouse benefit will not be affected. And Dick's other ex-wives' divorce spouse benefits will not be affected. If he has 3 ex-wives and if he was married to each one for 10 years, all 3 ex-wives may receive full divorce spouse benefits off Dick's record. And his current wife can receive her spousal benefit as well. The Social Security framers probably didn't think serial marriage would one day become fairly common when they developed these rules, but here we are and we can take full advantage of them. The savvy divorce spouse strategy is just like the savvy spousal strategy with a couple of small differences. When you turn full retirement age, you file a restricted application for your divorce spouse benefit. When you turn 70, you switch to your maximum retirement benefit. Back to our divorced couple. Dick is at $2,400, Dora is $2,000. When Dora turns 66, she files a restricted application for her divorce spousal benefit and receive $1,200 per month from age 66 to 70. When Dora turns 70, she switches to her higher retirement benefit of $2,640, which is probably higher now because of COLAs. With this savvy spouse strategy, Dora must have been born before January 2nd, 1954. She cannot do this before full retirement age. Here I sound like a broken record. If she files for Social Security before full retirement age, she'll be paid her own benefit and it'll be permanently reduced. She may not restrict her application to spousal benefit until she turns full retirement age. Here are the differences. Dick has to be at least 62 and he does not need to have filed for his benefit if the divorce occurred more than 2 years ago. And get this, Dick can also file for a divorce spouse benefit on Dora's record. The idea here is that divorced spouses can't control whether the other spouse will or won't file. So that's just not part of the rule for receiving divorce spouse benefit. Remember, Social Security does not discriminate. Your ex-husband could be receiving a divorce spouse benefit based on your record and you would never even know about it. Till death do us part, your Social Security records are interconnected even after divorce. You probably can't even imagine this now, but if you're married or if you're divorced, your husband or ex-husband might die before you do. Odds are he will, since women on average live longer than men. So you might at some point in your life become eligible for survivor benefits. If that survivor benefit is higher than your benefit, you are receiving at the same time at of your husband or ex-husband's death, you can switch to the higher benefit. So even though it may be a long way off, you need to understand how survivor benefit works because certain decisions made now can affect the amount of that benefit. I take that back. I take the till death do us part back. This goes way beyond and into the grave. Now, I want you to follow this carefully because the amount of survivor benefits can vary greatly. It depends on two things. The first factor is when your deceased spouse originally claimed his benefit. This is called original benefit. The second factor is when you claim benefit. This is called the actual benefit. These two events are usually separated in time. For example, your husband could claim his Social Security benefit at 62 and then live to 80 or 90 years old. You won't claim the survivor benefit until he dies, 20 or 30 years in the future. But the fact that he took his benefit at 62 means that it will be much lower than if he had taken it at 70. Husbands often don't think about this when they are 62 and deciding when to apply for Social Security. Back to the example with our married couple. Jack's PIA is $2,400 and he dies after the age of 70. The original survivor benefit will be $2,970 if he had claimed his Social Security benefit at 70. This is because his benefit includes 4 years of 8% annual delayed credits to bring $2,400 to $2,976, or it would just be $1,980 if he had claimed at 62. Let me ask you this. Do you think Jill would rather have a survivor benefit of $2,976 or $1,980? Unless she's crazy, she opts for $2,976. What does she need to do to make this happen? If she can travel back in time, she needs to get to Jack before he turns 62 and tell him to file for his Social Security benefit at 70, not 62. This is why we say that women should be the Social Security decision maker for the family. The age at which Jack files for his benefit would directly affect Jill's survivor benefit, so she's the one who should be making that decision. Now we get to Jill's actual benefit. We already seen that the original benefit could be anywhere from $1,980 to $2,976, depending on when Jack filed for his benefit. Life is never that simple. Let's make it more complicated. Jack died and Jill is sitting wondering when she should apply. If she's over 60, she can apply at any time. In fact, if she goes to her Social Security office and tells them that Jack has died, they will probably encourage her to go ahead and apply for her survivor benefit right then. Social Security people are in the business of helping people get all the benefits they are entitled to right now. But from a long-term perspective, this may not be the best move. The amount you start with is the amount you will stick with throughout your life. So it pays to start with the highest amount possible. As we can see on this table, if Jill applies for her survivor benefits at age 60, she will get a fraction of the original amount, just $1,716 per month. We can also see that if Jack had applied for survivor benefits at 62, Jill will get a much smaller survivor benefit regardless of when she claims it. The most she can get is $1,980. But if Jack had claimed at 70, and if Jill claims her survivor benefit at full retirement age or later, she can get as much as $2,970. There's a huge disparity in these benefits amount from a low of $1,716 to $2,976, depending on the decisions they make. These decisions will determine Jill's standard of living later in life. Survivor benefits can be claimed as early as age 60 or 50 if you're disabled. But remember that if you claim at 60, the amount will be reduced. So young widows shouldn't automatically file for their survivor benefits as soon as they turn 60. You need to analyze all of your Social Security claiming options before deciding when to file. Also note, if you collect your Social Security benefits before full retirement age, you are still subject to earned income limits test as discussed previously. To qualify for a survivor benefit, You must have been married to the person who died. Living together doesn't count. If he died during the marriage, you only need to have been married for 9 months. If he died after you divorced, that marriage must have lasted for at least 10 years. By this way, same-sex couples can now get Social Security benefits if they are or were legally married and live in a state that recognizes gay marriage at the time of application. When planning ahead for when you might be on your own, remember that you can receive the higher of your survivor benefit or your retirement benefit, but not both. So if Jack is receiving $2,976 and Jill is receiving her spousal benefit of $1,200, let's say she doesn't qualify for Social Security benefit on her own record, she can jump up to Jack's benefit of $2,976 after he dies, but her $1,200 benefit will stop. Jill should plan ahead for this loss of income. We can help you with that. If your ex-husband dies, and if you're either unmarried or you're married and the marriage took place after age 60, you may qualify for divorced spouse survivor benefit. A lot of women won't think of this, especially if they were married and divorced many years ago. For example, Sam and Sue were married from 1970 to 1985. Sam died in 1995. Sue has not remarried. As soon as she turns 60, she will become eligible for a divorced spouse survivor benefit. Remember though, that if she starts it at 60, it will be reduced. So she might want to wait until age 66. Just to summarize what we've been talking about, if you think you might outlive your spouse or ex-spouse, and odds are you will, you want to encourage your spouse to wait until age 70 to start his Social Security benefit. Then you want to claim your survivor benefit at your full retirement age or later. Hopefully you will be well over your full retirement age when your spouse dies, but just keep this bit of information in mind. And then you want to coordinate your survivor benefit with your own retirement benefit. Remember, you never know when you might become eligible for a survivor benefit, so it is worth tucking this information away for when you might need it. What if you qualify for both retirement benefit and a survivor benefit? This will be the case with most of you. Now, if you and your husband are well over your 70 when he dies, it will be straightforward matter of taking the higher benefit. You'll either switch to your husband's benefit and yours will stop, or his will stop and you'll keep receiving your own benefit. What I'm talking about now is if you are under age 70 and qualify for survivor benefits now, and either because your husband has died or your ex-husband has died and you were married for over 10 years, and you also qualify for Social Security benefits on your own record. What you can do here is switch from one benefit to another, but you have to be strategic about it. You could start your own benefit at 62 and switch to your survivor benefit at full retirement age, or you could start your survivor benefit at 60 and switch to your own benefit at 70. Which of these two strategies you should do will depend on the respective amounts. What you want to do is to take the higher benefit last. This will be your permanent benefit, which you will receive into your old age. So you want to maximize it as much as possible. If you are in this situation, we can help you analyze your claiming option. If the survivor benefit is higher than the retirement benefit, you'll want to take retirement benefit at 62 and switch to the survivor benefit at full retirement age. So in this example, Linda would start her own benefit of $700 at 62 and then switch to the full survivor benefit of $2,200 at 66. Conversely, if the survivor benefit is lower than the retirement benefit, you'll want to take the survivor benefit at 60 or as soon as you become eligible for it and switch to your retirement benefit at 70. In this case, Dora has a high PIA. Her survivor benefit is $1,800, which is less than her own benefit. So she claims her survivor benefit at 60 and receives the reduced amount of $1,287 from age 60 to 70. When she's 70, she switches to her maximum retirement benefit of $2,480. If you're divorced or widow and thinking about remarrying, keep these rules in mind. If you remarry on any age, you can't receive divorce spouse benefits. So if you're already receiving divorce spouse benefits and thinking about remarrying, understand that your divorce spouse benefit will stop. However, you may be able to get spousal benefits based on your new husband's record. If you marry before age 60, you can't get survivor benefits or divorce spouse survivor benefits. If you remarry after age 60, you can still get survivor benefits or divorce spouse survivor benefits. I know these rules are hard to keep straight, and I could barely even say them without getting my tongue tied. Don't try to memorize them. If you have questions, you can always ask us or call the Social Security Administration. Here's a summary of survivor planning if your spouse or ex-spouse is still living. If you're married, encourage your spouse to delay his benefit to age 70. As for your own benefit, consider your spouse's life expectancy. If your spouse has some health problems and may have a shorter life expectancy, you could go ahead and claim an early benefit on your own record because you'll be switching to your survivor benefit at some point. On the other hand, if your spouse is in good health and has a long life expectancy, you should maximize your own benefit by delaying it to age 70 because you'll be receiving it for many years before switching to the survivor benefit. This will maximize your income to you as a couple while you're both alive. If your spouse or ex-spouse is already deceased, do what we talked about earlier. Compare your own benefit to your survivor benefit and take the higher benefits last. Just remember that if you remarry before age 60, any survivor benefits you might be entitled to from a previous spouse's record will not be available to you unless the remarriage ends. Do what you want, but it's just a financial consideration. As we wrap up, consider this. It's not so far-fetched today to live well into your 90s, if not 100. Social Security, one of the best income sources because it provides inflation-adjusted income for as long as you live. The decision you make in your 60s will determine the amount of income you have for the rest of your life. The difference between early and late claiming will grow as annual cost of living adjustment cause the higher amounts to grow faster than the lower amounts. Delaying the start of benefits will give you more income later in life. Coordinating spousal and survivor benefits may give you extra income while you delay your main benefit, but Social Security decisions should not be made in isolation. Social Security alone is not enough income for most people. So you should make your Social Security decisions with the context of your overall retirement income plan. Obviously, the longer you delay collecting your benefits, the more you will receive. It's important to realize that the decision of when to apply for Social Security depends on many factors unique to your situation. There's no one size fits all. What's your health status, life expectancy, need for income, whether or not you plan to work, and if you are a surviving spouse, whether you have other personal resources. It's important to consider Social Security in the context of your other retirement resources, including pensions, IRAs, 401ks, required minimum distributions at the age of 72 or later, your overall investment portfolio, and your plans for working in retirement. All of these resources should be coordinated to give you the income you need for the rest of your life. Please don't be afraid to ask for help. Retirement planning is easy when it's a matter of stashing part of your salary into a 401k or IRA. But when time comes for you to convert your nest egg into an income stream, you want to make sure it doesn't run out. Social Security may be the bedrock of your retirement income plan, but it must be coordinated with your other resources to give you the stability and security you deserve. And now we have Larry, who will wrap up our webinar today.
Before we wrap up today, Belinda, we do have a couple of questions. The first question, somebody's asking about, they heard that there won't be any money left for Social Security. I'll answer that one. Yeah, there are some projections out there that say that down the road, Social Security could run out of money, but I highly doubt that the government's going to let that happen. It would probably be political suicide for anyone doing that. So they'll probably need to figure out how they're going to raise some more money so they can continue to pay out Social Security, especially as our population ages. So that was,
And I'm going to add to that, Larry, is that they say that trust funds may run out, but don't forget, so long as people continue to work, they're still collecting Social Security taxes. It's just that they're saying that the people who are currently collecting benefits may see their benefits reduced, not necessarily, it wouldn't go from their current benefits to nothing.
yes, again, hopefully they're not going to be, the current benefits won't be reduced, but there may be some other things that come into play. But right now, it's not something that's on the imminent in the near future. One other question here, I'll let you take this here, Belinda. Someone's asking, what about if they've been divorced more than once? How does that affect their benefits?
Well, you get to choose which divorce spouse benefit that you would like to take, and most people would choose a higher one. And then also, do you meet the qualifications as we have said before? So the marriage must have lasted for 10 years. Your ex-spouse has to be 62. And if you have divorced after 2 years, then so long as the ex-spouse is 62, then you will be able to file. And also, if you're eligible to file, whether you're at 62 or your full retirement age.
Great, thanks, Belinda. And as Belinda pointed out, there are so many questions that have to do with Social Security, but it's also coordinating the Social Security with your other retirement benefits, the different ages between you and your spouse, the health situation. So really putting together and doing a proper retirement plan, really one part is a Social Security analysis. And for everyone who's attending the webinar today, we are offering a free Social Security analysis. So you can go to our website, hellowealthmanagement.com, and scroll down and click on the free financial diagnostic call and set up a 20-minute call, and we can begin the process of doing a Social Security analysis for you. And if anyone else has any interest in contacting us about looking at their whole picture, their investments, their financial plan, their retirement plan, and of course, maximizing your Social Security, feel free to give us a call at 631-293-2806. So thank you, Belinda, for the presentation. A lot of important material, especially for women that are living longer, as you pointed out. And for everyone out there, thank you for joining us for today's webinar.